Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SPIRIT AEROSYSTEMS Holdings INC quarterly report. SPIRIT AEROSYSTEMS Holdings Inc. offers a diverse range of businesses and services across three main segments: commercial, defense and space, and aftermarket. The company's commercial segment provides various aerostructures such as fuselage sections, floor beams, nacelles, struts/pylons, horizontal and vertical stabilizers, flaps and slats, flight control surfaces, wing structures, and wing systems for commercial and business/regional jet programs. In the defense and space segment, SPIRIT AEROSYSTEMS engages in the fabrication, bonding, assembly, testing, tooling, processing, engineering analysis, and training on aerostructures for U.S. government defense programs, including missiles and hypersonic solutions. The aftermarket segment offers maintenance, repair and overhaul (MRO) services, spare parts, repair services for flight control surfaces and nacelles, radome repairs, rotable assets trading and leasing, engineering services, advanced composite repair, and other related services to both commercial and defense programs. SPIRIT AEROSYSTEMS Holdings Inc. (SPR) saw its stock price rise by 11.52% over the past year due to several key developments. The progress toward Boeing's acquisition of SPIRIT AEROSYSTEMS was a significant catalyst, with regulatory approvals from the UK and European Union clearing the path for reintegration. This move is expected to unlock value and stabilize operations. Increased production activity across various programs, including Boeing's 737 deliveries, also contributed to the positive sentiment. Additionally, the divestiture of Fiber Materials, Inc. may have been viewed as a strategic move to streamline operations or improve liquidity. While SPIRIT AEROSYSTEMS faced challenges, such as wider-than-expected losses and supply chain issues, the anticipated benefits from the Boeing acquisition appear to have offset these concerns, driving the stock's overall increase in the past year. The primary drivers of revenue growth or decline in the aerospace industry are largely influenced by production and delivery rates, as well as market demand for specific aircraft models. On one hand, increased deliveries of Boeing's B737 and Airbus A320 have contributed to significant revenue growth. Additionally, higher production on certain programs, such as the Sikorsky CH-53000 and P-8 units under Boeing's B737 program, has also driven growth in the defense and space segment. On the other hand, a decrease in expected deliveries to Boeing due to changes in production and delivery processes has led to revenue decline. Furthermore, limitations on increasing production rates and uncertainty around customer advances and repayment terms have also contributed to this decline. Global economic and trade conditions, inflationary pressures, interest rate increases, tariffs, and volatility in the trade environment are other factors that may impact revenue growth or decline in the industry. Net income and profit margins decline. Due to economic pressures, the net income of a company has experienced significant decline over the past year. In 2024, the company reported a net loss of $299.4 million, which increased to $613.4 million in 2025, representing a 106% decrease. The net loss margin also worsened from -32.3% to -45.6%. The operating loss margin saw an even more substantial decline, decreasing by 17% from -23.8% in 2024 to -40.7% in 2025. This downward trend is attributed to various economic factors, including inflationary pressures, interest rate increases, and geopolitical events. Segment-wise, profit margins also suffered, with the commercial segment experiencing a decrease in operating margin despite an increase in absolute terms. The defense and space segment saw its operating margin drop from 14% to -4%. Only the aftermarket segment maintained its operating margin at 9%. The primary reasons for these changes are increased costs, such as energy, freight, raw material, and labor costs, as well as tariffs announced by the U.S. and other countries. These factors have collectively contributed to the decline in net income and profit margins. The company's financial performance indicates a persistent issue with generating positive operating cash flow. Despite various time frames and specific periods analyzed, the data consistently shows negative operating cash flows. This trend suggests that the company is struggling to generate sufficient revenue from its core operations to cover expenses, resulting in a net outflow of cash. The company's financial performance varied across different segments and regions in 2025. The commercial segment showed a slight improvement with a 3% increase in net revenues, while the defense and space segment saw an operating income gain of $54.4 million. However, this growth was offset by poor performances from other segments. The aftermarket segment remained relatively stable, but the other segment experienced a significant decline with an operating loss increase of $400.6 million. The commercial segment also struggled, with its operating loss increasing by $257.7 million. Overall, while some segments showed improvement, others continued to underperform, indicating areas that require attention for future growth. Management's outlook on company strategy. The company's management has expressed concerns about its financial performance, expecting to generate operating losses for the foreseeable future. To address this issue, they are developing a plan to improve liquidity through various means, including divestitures, customer advances, and restructuring operations. In terms of strategy, the company is investing in tooling and capital expenditures to increase production rates on the B787 program. However, this will be aligned with deliveries to Boeing starting April 2025 through October 2027, indicating a cautious approach to investment. The management also expects reduced profitability due to inflationary impacts until normal historical levels are reached. Furthermore, they anticipate that production rates for narrowbody aircraft will recover before widebody production rates. Overall, the company's outlook is marked by uncertainty and a need for additional funding to sustain operations. Management is working on a plan to improve liquidity, but there can be no assurance of its success. The company has engaged in several strategic transactions, including acquisitions and divestitures. Key acquisitions include a merger agreement with the Boeing Company and the purchase of A350 FLE shipsets from Airbus. On the other hand, the company has also divested certain Airbus businesses, with repayment terms tied to closing. The company has not paid dividends to its shareholders. Despite a reported $0 cash dividend per common share, this appears to be an error in reporting, as page 77 confirms that no dividends were paid in either period. Furthermore, there is no mention or indication of the company buying back shares. Concerns about inventory buildup and supply chain disruption are evident in Spirit's financial summary. Inventory levels have increased significantly, with a net increase of $321.8 million from December 2024 to October 2025. This is attributed to various factors, including Boeing's change in production and delivery process, which has resulted in higher levels of inventory due to advance payments not yet repaid. Supply chain disruptions are also a concern, with decreased expected deliveries to Boeing, strikes by Boeing employees, and limitations on increasing production rates contributing to the issue. The buildup of undelivered units in Wichita, Kays, and increased supply chain costs on various programs have further exacerbated the problem. Economic and trade conditions, including prolonged global inflationary pressures and the war in Ukraine, have also impacted Spirit's results of operations and cash flows. The combination of inventory buildup and supply chain disruption has had a significant impact on Spirit's operating cash flows from continuing operations, with confirmed obligations to suppliers increasing by $46.3 million during the 9-month period ended October 2, 2025. These concerns highlight potential risks for Spirit's future financial performance. That concludes the financial summary for Spirit AEROSYSTEMS Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.